welcome to this video. Don't forget to like, share, comment, subscribe wherever you're watching. Follow me on TradingView and of course get my free training underneath the video. So the Swiss yen, I'm going to go fully over this in a very, very detailed approach because it's something which is probably going to cause a lot of people to lose their money if traded incorrectly. Now, there's a large build-up to where we are now and why and what to look for the future, in my opinion. And you can see the data back to 1972 on TradingView via this ticker. Okay, I believe it's FXCM. That's right. So an FX broker. I think they're integrated on TradingView. But anyhow, if you just look at 72 to 22/23, it's 50 or 51 years of information to digest. Now, there's two parts to the story, okay, or perhaps three parts, I would say. The first part is where you reach up here in 1979, so 7 years after 1972, and you come to a point where you have this big peak price, big rejection there, okay? So that leads to a big fall, and it leads to the second part of the story of the Swiss yen, which is where you bottom out. You get this terribly low price, the Swiss franc loses an awful lot of value against the Japanese yen, and you get to this point. Now, the reason why, and it's very much worth noting, the reason why currency pairs change in value is directly connected to the monetary supply or the policy within that economic zone. Okay, so whatever they decide to do with the interest rates correlates straight through to FX markets, obviously, because interest rates control the interest at which you're gaining on your savings or the amount it costs to borrow. So it's all very much money based. And that's the job of the central bank, essentially to control the value of currencies, control interest rates, borrowing costs, everything. Keep the economy ticking round in the best possible way. Okay, now I could go into the in-depth economics around the value of a currency and what's preferable and what's not. Okay, but I'm not going to do that today. Essentially, all you need to know is if you've got a strong currency, your imports are going to be cheap, so what you bring into that area, and your exports are more expensive. So considering whether you're an exporting economic zone or a importing one, is going to have a lot of an effect on how the currency is valued. Japan exports a lot, and their currency is very much devalued. Okay, you can see you get currently 169 yens for every Swiss franc. Okay, 169 times. So after part two, you get to where we are now, essentially part three. So all of this happens within, so you'll move from 2000 to 2023 where we are now, and you've got to move from 1972 to 1979. Okay, so over this 51 years, in other words, you've come up high, you fell down very low, and you come up again. So I think essentially what people are looking for who are trading this is the move back. They're looking for this massive swallowing up and a big reset in price. So I suppose it's probably best if I give my opinion on that, because some people are saying, you know what, I'm going to sell my house and short everything, and it's completely the wrong approach. Okay, just because you come up and up and up and up doesn't exactly mean that that's not going to continue, and you've got to be very wary of that. So if I go on to something like my monthly now, you can see that you've had an enormous amount of up move. Okay, you brushed along your key moving averages over here. Okay, your 20 and 40 and 100, they all circled together at this point, and they came right underneath. And then the price just starts to ride up. You have not hit your earliest 20 MA since, and that's a very long time. It's 3 years, and you've not touched those MAs, more than 3 years. Okay, that is more rare in financial markets. If you look at your stock oscillator or your RSI, or pretty much whatever indicator that you choose is best for you and that you use, it's probably going to be very high. It's important to note that all indicators essentially are doing the same thing, more or less, just over different time frames of data, more or less candles. So given all of that, given you haven't touched those MAs, given the stochastic oscillator, RSI, whatever you're trading with as an indicator is way up, you would surmise that it's a short. And it absolutely is a short, because at any time, if you're buying, you are buying highs. And if you do experience a very large fall, which inevitably is probably going to happen, because if you look back in history, it always does, the price comes down eventually, you'll be buying into that. So it's never a good idea to do that. Now, if you look on your weekly, you can see the story is much the same. And no matter what time frame you look at, really, it still remains with this short bias. Now, the key is this. Yes, it is going up, okay? And the falls aren't doing much. But when it does fall, especially on your weekly and daily, and you come back to these key early MAs, it gives you a chance to get out. Now, I would say getting out of falls early on this is ideal, because if it's rallying and rallying and rallying, and sentiment is taking those Swiss francs up against those yens, it's less likely that, like I said, eventually it's going to fall, but I don't think it's going to happen all in one go anyway. So if you're coming to very early areas of support, it's ideal on those falls just to exit, because they are going to provide the bounce, the trampoline, if you like, to rebound higher. And that's what sustains a long-term uptrend. That's why every time you come back, you're only falling only so slightly into these MAs. Now, it's worth noting that the Swiss franc has gained in value for a considerable amount of time over many FX pairs. If you look at the dollar Swiss, pound Swiss, AUD Swiss, they're all way, way, way down, because the Swiss franc has consistently gained value. Now, as well as the Swiss franc gaining value, the yen has dropped in value enormously against other currencies too. So you've got a mixture of both. You've got strength in the Swiss franc anyway, and weakness in the yen anyway. So the key thing to understand really is that if you're looking for a massive impending fall, it's not going to happen overnight. It's not all going to happen at once either. If you look where you had a fall from here, you're open in 1980, the end of the fall, really, before you get significant retracement, is more or less here. You get one here, but you don't bottom out, if you like, for 9 years. Okay? So the market eventually will run out of buyers. It will eventually say, you know what, we don't want to hold our long positions anymore. We'd rather get short. And that's what brings the market down. It's unsustainable for the Swiss franc to gain in value forever and the yen to fall in value forever. There are reports lately that the Japanese aren't totally concerned with it, but it's likely you'll get a point where that changes and ultimately it comes down. So really, after saying all that, the main point you need to understand is that my bias is short. I would never be buying this. The only time I would ever buy this is in line with my strategy, and that is hedging on early support and working my way out of trades as you go down. I've taken various hedge gains, because you've got to realize that, yes, the market has risen and risen and risen, but if you just look at things like this, okay, where I'm drawing these lines, you had a fall from 15th of August all the way through to October. Okay, so almost 2 months you had to buy this and sell it and buy it and sell it. You must have made money doing that. Therefore, if you get the next trade or entry via DCA and you find it going into drawdown, you'll be able to use those profits you had to get rid. So remember, if you've been DCAing all the way up, it's really important to note this as well. If you've been doing that, remember simply that the DCA entries you're taking, they count as an SL, effectively a stop loss, because if you made money, let's make it really simple. Let's say you made $100 in profit and draw down on DCA. So the amount your new position is losing money is minus $60. Your net $40. Okay, so you can use those dollar cost averaging profits, as many of you will be on a basic level. You can use the profits you've made already trading that pair to diminish what you're losing on your new entries, and do it early as well, because if it drifts and drifts and drifts, it gets much more difficult. But you can see, if you look over here on your monthly, you touch your key MA in about December 2012, and you don't really come back through it until November 2015. So that took 3 years, roughly. And you've now had 3 years again, only it's significantly further up. The reason why all of this happens anyway is because of your large fall. it's because of part 1 and 2 to the story. Part 1 showed you a big rise. Part 2 showed you a big fall. You're on the part where you rise past the previous rise and the increase continues. But eventually that has to change. Just like it did here, that was too much for the Swiss franc against the Japanese yen. And people will probably start to see that again. So if you do fall, I wouldn't be shocked if you eventually end up over here, because you can see there's key price action / rejection at this point with that very thin candle wick there. So my bias is short. Now, if you are trading it, I think the most important part of this video is the following. And there's a few things, I've said it a few times, but I'm going to reiterate it. You need to keep size small, and that's number one. The reason why I say that is because if you're someone who's seeing this and the emotions are coming in, I could make loads of money, you're kidding yourself. Be very careful. It may be the case that if you did short it, it would fall the next day. But you just can't predict that. You don't know when it's going to fall. You don't know what the best price is. The only thing you know in solid concrete fact is that the price is high, and therefore you should have short value naturally. So keeping your size small is really, really an essential thing to do, because if you're finding that the market is rallying against you and your size is really small, you'll be able to cope with the up move, or you should be able to. That's why I teach people to trade minuscule sizes in a diverse portfolio, because you're naturally, therefore, dropping your risk. Okay, smaller sizes, the risk is dropped. Now, number 2 is spread. Okay, and I don't mean, I'm going to change that actually. I mean spread out, not spread as in the difference between the price. The spread, what I mean by that is essentially if you are going to enter like you may have here, you really want to make sure not only your sizes are small, but also when you do enter, you're doing it away, a large amount away from your previous entry. Because essentially what you're doing here is you're casting a very wide net. You want all the fish in the water. You don't just go for one spot with one pot, okay? You put all the pots out, or you spread the net wide. And that's the same thing you need to do, because if you're looking to catch a longer term fall and make DCA work for you, then you're going to need your sizes to be small, and you're going to need to spread them out. Stop losses aren't going to do much in a rallying market, a persistent rallying market, because it's going to keep going up and up and up. Or if it does keep going up and up, necessarily, like you've seen, you might find your stop is removed and removed and removed and removed. So if you trade small enough, that's not going to be it's not going to be the issue. Okay, so you want to keep your size small and you want to spread things out. Those are natural ways in which you can catch a fall, and also obviously. And I mean, don't buy the highs if you're not hedging to mitigate loss. I mean, if you let the price come up and you say, wow, I'm going to get long. Like I always say, historically, that doesn't work as a method. You may have made money several times. However, eventually, you'll lose all of it. So you have to be very, very careful. The idea is not to buy highs. You know, if you can see your stock oscillator or RSI way, way up, you have to ask yourself, would I really like to buy into this? If I was going to buy anything else, wouldn't I let the price drop? And that's exactly what I think most would do. So to keep your emotions in check and to stop you looking for the next mammoth fall, all you really need to do is make sure that your sizes are small, you never go over a maximum, and you keep it well into a minimum or below your minimum. Yen pairs, naturally, in the most recent history, as you may have seen, tend to accelerate like this. It depends what way the pair is round. But if you look at the dollar yen, the Swiss yen, AUD yen, CAD yen, everything is up. So you have to understand that naturally yen pairs at this current point in time will rally or will deviate for a long period of time. And even so, I would say naturally they did to the downside. Okay, so they can trend and trend and trend, and they can spend significant periods of time being very sharp. So not like an oscillation, but a very sharp up move. So you've got to make those changes in order to control risk, because the pair you're trading is naturally less risk averse or harder to trade. And of course, at the end of the day, if you're new or you don't want to take on that risk, trade something else. There's a million things you can trade. If you are going to diversify across your yen pairs, be very careful as well, because if you add on more positions on the same based asset, okay, or everything that has a yen in it, when it all keeps going up, your drawdown is going to accelerate fast. So maybe pick one, spread it out, keep the size small, keep things safe, and you'll find it's far more long-term as a method. Thanks for watching, guys. Hope that helps. Get my free training underneath. Stay tuned. And of course, I will see you in the next one. See you there.